Another favourite technical pattern that traders use is the rectangle or consolidating pattern. This is a simple setup and I'm going to show you how to recognise it and how to trade it. Also, I'll give you a tip of how to trade the rectangle pattern before it's broken out and show you a strategy that some traders use in order to trade the rectangle pattern even if they're not sure whether it's going to break out or not. I hope you find this video helpful.
Welcome to this presentation on recognizing the rectangle formation as part of your technical toolkit. Now, trading the rectangle pattern involves, first of all, the ability to actually spot what the pattern is. Now, the rectangle formation can go by a variety of different names. It's usually pretty easy to spot on a price chart. And basically what it shows a pause in the trend during which price moves sideways, usually between two parallel horizontal lines. So if you just take a look at this example here, you can see that there's an uptrend in place. The uptrend pauses and you can see that price just ranges between those two parallel horizontal lines marked on the chart in front of us. Now, the rectangle is sometimes referred to as a trading range or a congestion area. In Dow theory speak, it's referred to as a line, but the name is not as important as what it represents, and it represents a consolidation period in the existing trend, and usually it's resolved in the direction of the trend. So, for example, in this chart here, you can see there's an uptrend in place, there's a period of consolidation, price ranges, and then it consolidates, and then finally breaks out higher in the direction of the uptrend. Now, similarly, you can take a look here. You can see an example of a downtrend. This is a bearish rectangle. Now, rectangles are usually considered continuation patterns, but you have to be aware there's always the potential for these patterns to turn into triple bottoms or triple tops. So you just have to be aware of that when you're trading them. Now, when should you use these patterns? Well, the ideal opportunity to use these is when you have a strong fundamental bias for a market to go a certain direction. So, for example, say you were trading an instrument and you had strong reasons to expect that instrument to keep selling off over time, then you would favor a break of the bearish rectangle to the downside, and you would look to go with a break of that level. Now, if you're trading a candlestick chart, often the clue, the hint, the signal of that break is you get a candle that closes below, in the case of a bearish trend, that bottom parallel line and closes beneath it. The daily close is a very important factor in that pattern. Now, when should you avoid trading the rectangle? Now, they're best avoided when there isn't any clear direction in a market from a fundamental basis. If you just recognized a rectangle pattern, then that is not a great opportunity to actually enter into a break of the pattern. You might see a false break, or if the market's uncertain, you're more likely to see a lack of clarity in trading it. Now, there's a little clue here, and one clue is look for the pattern of volume. So, for instance, if you see heavy volume on a break of the pattern, that's often a good indication that that is going to carry on in the trend, particularly if you're trading stocks. So you can see here, if you get the peaks, if the peaks are on lower volumes, but the troughs are on higher volumes, that's a good sign that the bears are in control. So volumes can be helpful here. You can also trade within the range. So say, for example, in this chart, you were expecting prices to keep moving lower, then you could trade at the top of the range, looking for a move back down to the bottom of the range. So there's a few tips that you can use with them. Now, the most common measuring technique what you want to do is you want to trade the height of the pattern. So you can see here the height of the pattern, that would be your target. And in terms of duration, you can trade these on a smaller time frame, but in terms of the daily time frames, they would usually fall into the 1 to 3 month category, quite similar to a triangle or wedge formation. See some of my previous videos, but you can also use these on a smaller time frame as well, particularly if you're, very, very sure of a trend or have strong reasons for the trend to carry on. And I will highlight a current example that we can see at the moment. This also means you can enter before the break. Now, normally the technical break would be a break of the line. So in the case of a bearish rectangle pattern, you enter on the break or the close below the bottom parallel line. In case of a bullish pattern, you enter on the break and the close above the top of the pattern. They're the opportunities when you can enter before the break, and again, when you have a lot of conviction in the trade. Here's a real world example. It's on a smaller time frame, but it does serve to show how these patterns can be used. This is a very simple pattern on the 2-hour chart. You can see this slight rectangle formation, and what you can see here is that price has been moving up from early February. Price has now been moving sideways in this consolidated range in this rectangle. You can see I've drawn the 2 parallel lines. And what we're looking here, we have a bias to buy the FTSE 100. Now, the reason we have a strong bias to buy the FTSE 100 is for the following reasons. One, Brexit has now been sorted for the United Kingdom. That is a risk that is behind the UK. There's no longer any chance of no trade deal. So that's supportive for UK stocks. Secondly, we've just had the Bank of England rate decision, and the Bank of England pushed back against the use of negative rates. We saw US 10-year bond yields spiking higher as investors begin to price out negative interest rates for the UK as a tail risk rather than a base case. Going into the start of this year, the UK was very much sort of expected to be using negative interest rates. Those expectations have receded. It's seen as a tail risk. That should be supportive for the UK FTSE 100. Around 19% of the FTSE 100 is made up of the financial sector. Financials tend to do much better when interest rates are higher because it means they can get more return for their loans. So it should be broadly supportive of the FTSE 100. So therefore, that's why I'd favour a break to the upside on the 600 level. If we see a break above this consolidating rectangle pattern, you'd expect a measured move higher of the size of this rectangle pattern. So it's a small short-term opportunity that serves to give a good example of how this could be traded. You could also trade this at market because you have strong convictions that you're looking for price to move to the upside. So even if price does drop below the rectangle, you're expecting price to carry on in the upward direction, which is the near-term local trend. So there's an example of trading the triangle pattern. It's not the best example by any means, but it is at least show the pattern, and it also shows some of the fundamentals that mean we're combining the fundamentals and the technicals together, which tends to give us the greatest chance and greatest probability of success with the execution of the trade. So I hope you found that helpful. If you have found that helpful, please do follow me on Twitter for my most recent updates on the latest videos that I've published. Also, you can follow me at LinkedIn and with my comments on the day, and check out my profile as well as a number of different articles I've written there. You can email me at giles.coghlan@hycm.com. Always glad to hear from fellow traders, see how folks are doing. And you can also follow my blog with the blog address there at hycmlab.com. I have new material up on that blog every single day. So, there's some great resources for traders there, as well as you can contact me direct. I have managed to put together a number of programs that really help aspiring traders take that next step up. So if you want to take your trading up to the next level, please do contact me there, and I can put you in touch with some great programs that we're delighted to provide for traders here at HYCM. Also, don't forget, every Monday I do FX Week Ahead live market analysis, where we look at the upcoming and the the best opportunities coming up for the week. So please do contact me there. You can come along the free webinar. Just register for that on the blog at hycmlab.com. You can register that. It would be great to see you there. Otherwise, thank you very much for listening. If you like this video, please do give me a like, hit the thumbs up, or share the video. Always much appreciated. Thank you very much for listening, and I look forward to being in touch with some of you in the future.